Hello and welcome back, guys. In this particular session, what we will be discussing about is section A, reporting and ethical implications of SPR's exam kit. So we are looking at Fiskerton at the moment, question number 15. Okay, so what we've been given is that, as per the question, the following extract is an extract of from the statement of financial position of Fiskerton, right? A public limited company as at 30th September 20x8, right? So non-current assets is given, current assets is given, equity capital is given, other component of equity is given, retained earning is given, non-current liabilities is given, current liability is given. So this is bank loan, right? So bank loan has a covenant attached whereby it will become immediately repayable should the gearing ratio long-term debt to equity of Fiskerton exceed long-term debt to equity ratio. Okay, exceed 50%. So Fiskerton has a negative cash balance as at 30th September 20x8. Okay, so first thing that we need to account for is Halem property. So we need to look at gearing and then lease as well, right? So this is lease or something. Included within the non-current assets of Fiskerton is a property in Halem which has been leased to Eddingly under a 40-year lease. The lease was acquired for 20 million on 1st October 2007 and was immediately leased to Eddingly. The asset was expected to have a useful life of 40 years at the date of acquisition and have a minimal residual value, right? Fiskerton has classified the building as an investment property and has adopted the fair value model. So why did it classify as investment property? So the property was initially revalued to 22 million on 31st March 20x8. That means exactly October, November, December, January, February, March, right? After 6 months. Whereas the interim financial statement had indicated that the gearing was 51% prior to this revaluation. So before this revaluation, the gearing was 51, right? So if our gearing exceeds 50%, we have to pay covenant whereby it become immediately repayable, right? So the managing director was aware of this breach of covenant and so instructed that the property should be revalued. The property is now carried at a value of 28 million, which was determined by sale of a similar size property on 30th September 20x8, right? So March, April, May, June, July, August, September, right? After 6 months, which was determined by sale of a similar sized property on 30th September 20x8. The property was located in a much more prosperous area. Okay, so it's similar only but not identical. Okay, so built with a higher grade of material, an independent professional valuer has estimated the value to be no more than 22 million. Okay, so it is no more than 22 million. Independent professional valuer, the managing director has argued that the fair value should be referenced to an active market and is refusing to adjust the financial statements even though he knows it is contrary to international accounting standards. So next is regarding sales contract, right? So what we've been given is sales contract is for second part. So discuss how Halem property should account for and explain the implications for the financial statement and the debt covenant of Fiskerton. So 1 marks per point, 7 points. So let's say first of all it should not be investment property. And what should it be? It will have a minimal value and then the whole life period of that is being used by the lessee, right? So that means it's a finance lease. According to IFRS 16, leases, the lease is a finance lease because lease this term is equal to the useful life of asset, useful life, and its residual value is deemed to be minimal, right? As such, the property should not be held as an investment property, but instead be recognized. Okay, should be derecognized from non-current assets. And the fair value gain, how much was the gain? So it was acquired for how much? 20 million. 20 million. First it was revalued to 22, later on 28, right? Now carried at value of this much at 30th September 20 exit, right? So 30th September is our closing date. Okay, so gain of first 2 and then later 6, that means 8, right? So 8 must be eliminated. The fair value gain dollar 8 million must be reversed. Fiskerton should record a lease receivable equal to the net investment in the lease, right? So it will only be as a receivable, right? Whereas if the lease was an operating lease, then the lease in the property should have been presented as an investment property, right? And any rental income would be recognized in profit or loss on a straight line basis. Okay. Any as per IFRS 13 fair value measurement, what level of information is there is that it is not similar kind of asset, right? So it's level 2, not on a listed price, but so even something with that level 2 will be level 3, right? The property was located in a prosperous area, right? Okay, so let's talk about that. The fair value were incorrectly calculated since adjustments should have been made for the difference between the Halam building, isn't it Halam though? Building and the one which was sold, right? And the one sold due to difference due to different location and quality of the material used. Materials between the two building, right? So it's not for a same asset, right? So it should be adjusted. The figure should have been adjusted. It should be level 2, not level 2 only, level 3 information, but it's not yet adjusted, so we need to look out for it. Okay, could say level 2. And then so what will be, therefore what will happen is that, come on man, therefore the building therefore the building's correct fair value would be 22 million, right? So what impact will it have in case of gearing, right? The incorrect treatment has enabled Fiskerton to remain within its debt covenant, because if it exceeded it, it had to pay all of it off, right? Covenant limits. Currently, the level is gearing as per financial extracts is around how much? Let's see. Okay, so what's the values? So debt divided by debt is 50, right? Is equals to 50 divided by bracket is equals to 50 divided by bracket. How much is the share capital? 10, and then 10.151, 10 plus other one is 20.151, 20.151 plus other component of equity is already done. Okay, so return earnings 70.253, 70.253, right? 49.8 percentage, which is basically 50 divided by, or you could say 50,000 divided by 10,000 plus 21 or 2151, isn't it? 2151. 51 plus the other figure is 7253. 53, right? Even after this, you'll get the same figure. Okay, so once this is done, since it was classified as investment property, so any gain or losses would be included in SOPL, so it must be removed from retained earning. So retained earning would be restated to dollar. How much should we remove from here? So minus 8, right? Minus 8, yep. Minus 8, okay. So 54.11. 54.11. Restated to, let's do it first of all. 7253 minus 8, right? 7253 7245. No, this is not in million. So it will be 70.253. It should be point, right? So 62.253. 62.253. 53 million, which is basically 70.253 million, figures in million, and minus dollar 8 million. 8 million now the actual gearing is 54.11, right? 54.11. 54.11 percentage, which is basically same figure, but we need to change something. This will be 62. 62, okay. All right. Anything else? Furthermore, retained earnings would be further reduced by correcting for rental income, right? Will go even down. Rental receipts, return earning, right? So that means our gearing will again rise. These presumably have been included in profit or loss. So we are just assuming, okay, because we don't have the information, right? Rather than deducted from the net investment in values. This should in part be offset by interest income, right? Which would be recorded in profit or loss at the effective rate of interest, right? We would be receiving interest on our receivable as well as per IFRS 9. Now, this is we're talking about lease anyway, right? So let's talk about the bridge. After correcting for these errors, Fiskerton would be in breach of its debt covenant. They have a negative cash balance, isn't it? Cash balance is negative at the year end. Negative cash balance and would appear unlikely to be able to repay because there is no cash balance. Repay the loan. Serious consideration should therefore be given as to whether certain is a going concern. So there is problem about that as well. If it is determined that Fiskerton will not, so it should be prepared on a breakup basis, right? Fiskerton is not a going concern in non-current assets and non-current liabilities should be reclassified to current and recorded at their net realizable value, right? Otherwise we could have just said that as well. If there is another possibility as well, discussing with the bank, right? If Fiskerton can renegotiate with the bank in the uncertainties surrounding their ability to trade must be disclosed. Right. So these are the impacts that it will have in the individual financial statement, right? So what would happen in case of this revenue? Okay, so we will need to talk about that as well. So for that, what we will do is that we will cover it up in next part. Okay, so it's already been too long for this particular question. So if you have any questions until now, if you did not understand anything, please do comment down below. I'll definitely answer it for you. I'll see you in the next question. Bye bye.